single day I'm gonna make something great. That's my way.
Hello everyone, and welcome back to my channel. I am Ginger Wolf, and this is Stripped Finance. I am a future entertainer and stripper, not a financial consultant. So any and all information received from this channel is meant only for educational, informational, and entertainment purposes. So please, if you have any questions or concerns, take it up with your financial consultant. Now with that out of the way, let's enjoy today's video. Bye!
Hello everyone. So today, just because this is something that I'm seeing happening in the stock market right now, I thought I'd do a video on it because a lot of you probably don't know this term, but I did find an Investopedia article on it by James Chen. It was reviewed by Charles Porter, and it was fact-checked by Suzanne Kivlog. I think it's Kivlog, I believe. But it's called Dead Cat Bounce. A dead cat bounce is a temporary, short-lived recovery of asset prices from a prolonged decline or a bear market that is followed by the continuation of the downtrend. Frequently, downtrends are interrupted by brief periods of recovery or small rallies, during which prices temporarily rise. The name Dead Cat Bounce is based on the notion that even a dead cat will bounce if it falls far enough and fast enough. It is an example of sucker's rally. A dead cat bounce is a price pattern used by technical analysts. It is considered a continuation pattern where at first the bounce may appear to be a reversal of the prevailing trend, but it is quickly followed by a continuation of the downward price move. It becomes a dead cat bounce and not a reversal after the price drops below its prior low. Frequent downtrends are interrupted by brief periods of recovery or small rallies which prices temporarily rise. This can be a result of traders or investors closing out short positions or buying on the assumption that the security has reached a bottom. A dead cat bounce is a price pattern that is usually recognized in hindsight. Analysts may attempt to predict that the recovery will only be temporary by using certain technical and fundamental analysis tools. A dead cat bounce can be seen in a broader economy, such as during the depths of a recession, or it can be seen in the price of an individual stock or group of stocks. Similar to identifying a market peak or trough. Excuse me, guys. Recognizing a dead cat bounce ahead of time is fraught with difficulty, and even for skilled investors. In March of 2009, for example, economist Nouriel Roubini of New York University referred to the incipient stock market recovery as dead cat bounce, predicting that the market would reverse in the short order and plummet to new lows. Instead, 2009 marks the beginning of a protracted bull market, eventually surpassing its pre-recession high. Let's consider a historical example. Stock prices for Cisco Systems peaked at $82 per share in March of 2000 before falling to $15.81 in March 2001 amid the dot-com collapse. Cisco saw many dead cat bounces in the ensuing years. The stock recovered to $20.44 by November of 2021, only to fall to $10 by September 2002. Fast forward to June 2016, and the Cisco traded for $28.47 per share, barely one-third of its peak price during the tech bubble in 2000. A more recent example is the price action in the market following the onset of the global COVID-19 pandemic in the spring of 2020. Between the week of February 21st and February 28th, 2020, U.S. markets lost around 12% as headlines began to hit and panic set in. The next week, the market rose 2%, giving some people the impression that the worst was over. But this was a classic dead cat bounce, as the market subsequently fell an additional 25% over the next 2 weeks. Only later during the summer of 2020 did the markets recover. Limitations in identifying a dead cat bounce. As mentioned above, most of the time a dead cat bounce can only be identified after the fact. This means that traders that notice a rally after a steep decline may think it is a dead cat bounce, when in reality it is a trend reversal signaling a prolonged upswing. How can investors determine whether a current upward movement is a dead cat bounce or a market reversal? If we could answer this correctly all the time, we'd be able to make a lot of money. The fact is that there's no simple answer in spotting a market bottom. A dead cat bounce typically lasts only a few days, although it can sometimes extend over a period of a few months. Reasons for a dead cat bounce include a clearing of short positions, investors incorrectly believing that the bottom has been reached, or from investors trying to find oversold assets. Ultimately, the dead cat bounce is not founded on fundamentals, and so the market continues to decline soon after. An inverted dead cat bounce is a temporary and often severe sell-off during an otherwise secular bull market, and it has the many characteristics of a dead cat bounce, but in the reverse. When a market drops, a relief rally may cause investors to think that the worst is over. However, it could just be a dead cat bounce, a sharp bull run in an otherwise secular bear market. Those that get caught in the dead cat bounce can experience losses, as timing market bottoms is extremely difficult and risky. Alrighty, guys. That seems to be the end of it for today. Yep, that is the end of the article. I hope y'all enjoyed this festive little snippet there. But that's gonna be it. Bye. Hi guys, thanks for making it this far into the video. While I'm cooking you up some new financial advice, don't forget to like, comment, subscribe, and if you can, share. And I'll see you next time. Bye!